So it's great to be here with John Connaughton from Bain. So if we think about what we've been talking about so far this morning, I would sum it up to paraphrase a lyric from the great band REM. It's the end of the world as we know it, but private equity seems pretty awesome. There's a huge level of optimism, it seems, around this industry. And I wonder if you share that optimism about sort of the opportunities out there in the world.
You know, I do share the optimism. I do think, though, you know, we tend to think of things in long-term secular trends, but then also in cycles. And, you know, the end of the private equity industry has been forecasted on a number of occasions. I know when I started in 1989, people said, you know, after all the Raiders and Drexel going under, that it was the end of the private equity industry in 1989. Similarly, in 2000, and certainly again in 2008, everybody remarked it was the end of the private equity industry. And I think that there is some truth that our business is far more cyclical than any of us would like. But the other truth is that the secular trends that are driving private equity are actually quite strong. Mm-hmm. We're very different than we were back in 1989. We're very different even than we were in 2007. And so the elements of our business model to create fundamental value creation versus the public equity model, versus corporations that oftentimes assemble in conglomerate form, the ability to go into international geographies, all of the elements of our secular industry growth still remain very attractive. Now, we are at the peak of many of the cycles. Valuation, fundraising, late-stage economic expansion, the credit cycle, all of those elements I do believe we can all be fairly conservative about. But long-term, I think we're going to find that coming out of the next cycle, we'll reinvent ourselves again to really be even that much better going forward.
And so let's talk about the peak for a second. Valuations specifically, I mean, is there any room to go up from here? I mean, I guess there's always room to go up, but how do you feel about that going through 17 as a buyer?
You know, I think that if you look at the underpinning of what drives valuation, I think, you know, part of it is the ultimate supply of capital. And the supply of capital that's coming into our industry is continuing to grow at a pace, I think, that is beyond the transaction velocity. So I think that element of the technical supply-demand imbalance could actually put some additional pressure. But I think the bigger drivers, though, are, you know, where are we with respect to the credit cycle? Mm-hmm. Where are we with respect to people's underwriting of a softening over the next 5 years? Because we do tend to look at 5-year investment horizons, so at least you'd have to believe there could be some dislocation in value or the economy in the next 5 years. And so I do believe that generally speaking, people are underwriting some form of dislocation as a result of where we are in the cycle. And so I do think that puts more pressure on valuation on the buy side. Mm-hmm.
And how much competition is, just staying with deal making for a second, how much competition is there out there right now, both from other sponsors and from strategics who seem to be pretty fervent right now?
Yeah, I mean, I think one of the most interesting elements of this particular cycle, this particular recovery since 2008 has been the fact that the presence of strategic in our processes have been much more prevalent. If you go back to the other recoveries, I think there was much more of a tentative approach towards M&A by corporates. They've actually used their balance sheets in ways we haven't seen in prior M&A cycles. And so because they have free cost of capital and because every time they do a deal, their stock price goes up, they've accumulated a lot of assets that might have otherwise, in normal M&A cycles, gone to private equity. Right. I think we've also seen a lot of these stable, low-growth assets, and everybody has been putting a huge premium on stability. And so when you talk about secondary buyouts or you're talking about anything that has any type of stability or lower growth, levered enabled, those assets have gone for extremely high prices relative to the fundamental value of the company because it's not that growthful. So I think that part of the marketplace is robust in its competitive intensity. Mm-hmm. You know, at the same time, there's lots of dislocation. There's a lot of carve-outs, there's a lot of founder-based businesses. We're looking at a lot of restructurings that are cross-border. We find that there's still an element of the market that is very much more inefficient, but that stable, low growth, larger deal environment, you know, it just marches up where anything you bought this year, you could have bought, you know, 2 years ago for 15 to 20% less.
Right. You mentioned carve-outs and taking the long view, it makes me wonder whether we'll see in this next cycle more carve-outs given the activities of strategics right now? That's a place you guys have played, I think.
It's certainly part of the cycle.
Yeah.
Again, it's a circle of life. M&A, generally speaking, starts with the premise that we're buying assets that other people don't want. We're not the first choice many times for companies to go and sell their assets to, but at the end of the day, oftentimes companies will build up big platforms, buy businesses they shouldn't have bought, and then ultimately need to shed those businesses. I mean, Valiant's your best example of this. I do healthcare investing for most of my career, and there was a period of time over the last 5 years where every single life sciences deal that we looked at, we were outbid by Valiant. They've accumulated a lot of assets. They used a lot of financial engineering to do so, and as a result, they were the buyer of choice. Not surprisingly, now that they've built that platform, we're seeing a lot of assets being shed by Valiant. And that is the nature of, I think, what makes our business so attractive, is that we can take assets that otherwise should not have been owned by those corporations and then buy them. So I think it will be a big part of the next cycle.
Right. And you mentioned healthcare. How do you feel about sort of healthcare as a sector, as both a buyer and a seller right now, especially with, and we'll sort of delve into politics a little bit later, but especially given the overlay of Affordable Care Act potentially being changed, repealed, or somethinged in the U.S., what does it feel like to you from a healthcare perspective?
Yeah, I think there's two elements of, I think, the question. One is just what do you think fundamentally will shift in the underlying regulation and the market forces and the privatization of healthcare that comes with that? And, from my own perspective, the fundamentals, I think, probably will shift more on the margin over the next 5 to 10 years. But I do think people do get wrapped up in overbuying the Affordable Care Act when a lot of the healthcare services company thought there was going to be this panacea of revenue coming in to cover the uninsured, when the reality is it just got reallocated from the commercial markets. And so the absolute revenue coming into the industry was far less than the rhetoric associated with all the enthusiasm of the Affordable Care Act. Likewise, if in fact some of that revenue or that perceived revenue goes away, I think that it won't be as impactful on the fundamentals. Now, on a valuation standpoint, we're seeing huge dislocation in healthcare services companies where people are worried about this regulatory change and finding that they don't want to underwrite that risk. And that's where private equity comes into play, where we can look beyond perhaps the current view, which is somewhat scary and uncertain, and look to the long view of really what's going to be a driver of healthcare services in the U.S. economy. And frankly, those things are pretty solid. I mean, technology is allowing for greater and greater tracking of care. Reimbursement methodology is becoming much more value-based on outcomes. We're seeing a lot of consumer-directed healthcare, which I think creates a much more logical commercial market for healthcare. And so all these trends in healthcare will continue regardless of the ebbs and flows of perception around regulation. So
long-term, you're bullish on healthcare?
Long-term, I'm bullish on actually the privatization of healthcare. Yeah. I think the thing that people forget is that 20 years ago, the participation by corporate entities in Medicare and Medicaid in the U.S. was very low. Over time, we've had huge explosion in Medicare Advantage and managed care participation in the Medicaid population.
So when you sort of think about the world, a world of opportunity, and you're sitting in an investment committee, what are the themes that you're hearing your sort of partners pitch to you as they come back from trips or they come back from diligence? What are the things that really stand out in the world right now, either sector or geography?
Well, I do think that one of the virtues of our industry, with the depth that we've all created in the verticals that we're in, is that we're able to take out costs, sure. We're able to buy and sell companies, sure. But one of the biggest themes that we're seeing is the consolidation of the industries that we're participating in. And that's on a global scale, and that's also within each geography. And so because the depth of our verticals has been so robust, we've actually been able to buy two companies at the same time. We used to call it the triple Lindy in private equity, where you're able to actually buy two companies at the same time. And we've done that not because we just know the company we're buying, but we know the industry so well that we can actually put the pieces together and actually then buy down the multiple through synergies. So we're effectively acting as a strategic acquirer. So the big theme, I think, and the way our industry really has advanced since the crisis, is that the depth of our knowledge in these verticals really allows us to act strategically. So it's not just about we see a company and we start to learn and understand the industry. We already know the industry. We know the fact that what we're going to do with that particular investment theme. We've bought 5 payments businesses in the last 5 years. We've bought businesses that are growth technology payment businesses through our venture platform. So from the perspective of the depth that we know those industries, we know them better than any individual participant in the industry, and therefore that kind of thematic can really allow us to really lean into a transaction.
I want to shift to your thoughts about the kind of investor side of the equation. There are a lot of LPs in the room and sort of wandering the halls of this conference. And one of the secular changes in the industry seems to be a ever-growing base of LPs, generally a more sophisticated base of LPs. What does that mean for you as a GP? This is sort of keying off some of the themes that we were listening to before we came on stage. Like, how does it change the way you do business, the current state of the LP market?
Well, look, I think there's 2 elements to that I'd observe. One is just this whole trend towards direct and disintermediation, if you will, of where the GP sits in the value chain from evaluation to sourcing to closing and operating and then selling. And I think that from the perspective of LP's increased interest in going direct, I would say there is a segment of the marketplace that frankly, it makes a ton of sense, or at least it makes a ton of sense not to pay 1.5 and 20 for a business that ultimately is sharing of very stable assets that still, by the way, benefit from the virtue of long-term orientation, active governance, cost of capital, but there really isn't that additional factor, which is building a management team, transforming the business, doing a lot of M&A. That kind of business, which I think is a different part of the market, is very difficult, I believe, for most of the LP community to participate in. So there is the segmentation between where some of the larger deals, the more stable deals, are really something that you're finding people partnering with LPs because the gross to net on those deals, is going to be attractive to them if there's no fee or carry on that co-investment part. But on the other hand, it's not as resource intensive, I think, as the rest of the market.
Right. Do you find that it is more difficult? I mean, obviously you guys have a long history in this business, and so maybe your experience is different, but is it harder to differentiate yourself when you're going to pitch these days, given the amount of GPs that are out there and also the amount of LPs that are out there? How do you sort of make the case?
Well, I do think, our heritage, as many of our LPs hopefully would support, is the fact that we have generally been much more resource intensive. And so the complexity of what we try to take on, either globally or through the depth of the transformation in cost or revenue enhancement, we've had to get better and better at all the elements of what can make us able to generate not just a good return, but a great return. Our goal is to develop 15 or so investments in a fund that each have the potential of not just generating an okay to good return, but really an exceptional return, which means that we need to grow earnings at double digit. And to do that, you have to actually have resources to allow yourself to accomplish that task. So whether it be bigger teams, on any given day we have 100 people, full-time equivalents, working inside our companies to support whatever that transformational initiative is, whether it be depth and specialization, talent, digital, which is a big one, marketing resources, technology transformation, where we're carving out businesses and have to go through an IT separation from a larger parent. These are resources specialized in our firm that we can actually bring to bear to make us that much better at taking on, again, the part of the market that is not for the broad-based group of participants, but actually for people that have those kinds of capabilities.
And do you feel like LPs are still willing to sort of, as it were, sort of pay up for that? We hear a lot about fee pressure generally across the industry. Where do you guys come down? Where do you come down on sort of general fee pressure right now?
Yeah, I do think, look, there's an element of fees for what you get, and so delivery of returns is going to be the critical element to fulfill the promise of the traditional 1.5 and 20 model. But when you get to scale, much larger scale, if you are participating much more in what I'll call the levered beta part of the market, that's where I think the greatest fee pressure is. In fact, the fee pressure is beyond what you might see as lower fees on the fund management pool, but it's also this co-investment participation.
Yeah.
But if anybody out there is trying to deliver the traditional 15 to 20% net, which is the top quartile performance for our industry, that will exist and be paid for under a traditional model for economics.
So overall fees, sort of generally speaking, fees go down, but
the scale of what you're accomplishing and the pool of revenue that you're deriving from that, could be either growing or stable. Right. In fact, in our model, we made a lot of strategic choices over the last 5 or 6 years that we're perfectly prepared to trade off fees for higher participation in the upside on average across our platform, because we have a class of product that actually they'll pay a lower fee for our investments, but we get more of the upside. So on average, we're at 23% of the upside, and we have more than 10% as our personal capital. So when we think about what we're deriving in terms of the value proposition, it's really about optimizing the performance return element, which for us is 75 to 80% of the economics.
Yeah. And how much do you worry about sort of the capital overhang, as it were, the dry powder number, which, is in excess of, I think, $1 trillion, trillion plus at this point? Obviously, that's not just you, that's a lot of people. How much do you worry about that driving some, for lack of better terms, sort of dangerous deal making, some overpaying? How much do you see that playing through?
As I started with, of all the things to be optimistic about longer term, the more short-term technical challenge is the fact that we don't have the flow to accommodate that supply. On the other hand, I do believe that there are elements in this next cycle that ought to unlock more supply of deals. So one is what I described about all these companies that bought too many companies that really don't strategically fit well, but they could pay for them with free cost of capital. That element will actually grow over the next 5 to 10 years. I do believe the take privates and large scale deals have been caught up through the pressure on the banks, through the regulators to not really lean into in scale commitments that would allow for larger deals. And so I do think that large deal market we're seeing increasingly return, but it still will take some time. And then finally, I do think the public to private black eye that our industry really suffered during the last peak has taken some time to rebuild. So all of those elements, plus perhaps international expansion, I think will accommodate growth. I can't see it like in the next 6 to 12 months, but certainly if you go out a little bit longer, there's a lot of reasons to believe that the LBO cycle, if you will, the LBO volume cycle, ought to bring more assets to market over the course of the next 5 years.
And to that point, what is the biggest sort of fundamental difference between sort of the next, not this peak, but the next peak and maybe the sort of 06, 07, when we had all those kind of public to privates, if you can predict?
No, it's a great question. I know that there's been a lot of people trying to analogize, 06 and 07 to 2016 and 17. Other than the 6 and 7, I think there's a lot of differences. When we looked at recessions and tried to underwrite recessions, we did what most private equity firms did. We looked at 82, we looked at 91, we looked at 2000, as really times where there were different kinds of recessions. The global financial crisis was highly geared, highly levered, highly consumer and industrial cyclical, and it was broad-based globally. And so I do believe that the elements of this next cycle are going to be much more segmented. Segmented by geography, segmented by industry. Some industries will take a long time for the air to come out of the balloon before it expands again. Even industrials. Look at auto OEM. Auto OEM, people get caught up in the U.S. auto build. But the U.S. auto build's like 15% of the global auto build, and OEM suppliers in the automobile industry right now are all global. And so it buffers some of the cyclicality that you see in the auto OEM business. So there's these elements that I think are not going to be as severe, and they will be very situational to different segments where you're going to see that dislocation.
So before we wrap, I did want to at least pin you down a little bit on the current geopolitical, geoeconomic environment. What is happening out there that actually, if anything, that actually sort of changes your behavior as an investor? If you think about potential regulatory changes, if you think about sort of protectionism, what do you guys talk about inside Bain in terms of how you act over the next year?
Look, I think, again, there's the actual rhetoric around some of these geopolitical risks and how they affect fundamentals. And again, we're long term, so fundamentals isn't next year. Fundamentals is next 5 to 10 years. And so you have to ask yourself, with respect to all those questions in the geopolitical side of things, as to whether it's going to change the fundamentals. In the short term, it might. In the long term, it probably won't. So will we see any disruption in long-term globalization and cross-border trade? I don't think so over the long term. Over the short term, will we see some valuation dislocation that results from people worried about certain elements of regulatory change or tax border revenue? Sure, you should be worried if you're a retailer in the U.S. in the short term. You should be worried about the elements of how it will affect globalization with China. These are elements that will for sure be affecting valuations, but that's what's good about our industry, is when they get oversold on the downside or overbought on the upside, like the public equity markets are today in general for what we see with Trump, is it's not going to be, in matters of degree, nearly as disruptive as the volatility in valuation suggests. So today in the U.S. market, we're very worried about the fact that there's a lot of things in direction that we should be excited about. Lower regulatory, lower taxes, lots of very interesting elements that could drive growth. But are they being overbought in matters of degree, that the outcomes will be nearly as fundamentally different as they are suggesting they will be? I think they probably are. And so, we're probably a lot more conservative, therefore, on valuation than the average public view.
Right. And in terms of, as we wrap up, the net effect on how you run your business as a private equity firm, what's the outlook there with some potential regulatory changes, whether it's looking at Dodd-Frank, whether it's corporate tax rates going down, as you mentioned? Is that ultimately a bullish case for private equity?
The case for private equity that is most valuable is where there's stability in those elements, so that when we create an investment horizon, we have a pretty good idea of what our tax rate's going to be and a good idea of what we can deduct or not deduct. So I think that certainty would be helpful on that front, which we don't have, but it does require us to have to alter a little bit of our view on how much capital depreciation do you have that you can write off in the first year? How much interest deductibility for that asset is going to be relevant to your investment return? How's it going to affect your exit value if things change on those fronts? Is it a retailer that's going to be potentially impacted by a border tax? So yes, as a result of that, we have a Trump fan. And the Trump fan is wider than the Obama fan. And that Trump fan, therefore, needs to contemplate a broader set of scenarios. But the good news is, in certain sectors, the fan is wide enough because people are so fearful, or on the other hand, we sell a bunch of businesses because people are so optimistic about the Trump fan that we've been monetizing at 4 times the rate than we've invested in the last 4 years. We've sold $40 billion, we've put $12 billion to work. Right. Because people are really overbought into sort of the direction of where things are going. And I think that's the way we play our business. It's be dynamic around not just the fundamentals, but really people's view of value of those fundamentals.
Good. I'm going to let you get back to your fan. Thank you for spending some time with us, and I'll turn it back over to you, Joe. Thanks. Thank you.